growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. That's really it. I mean, there might be something that transitorily impacts markets for a day, like tariffs or the government shutdown. But to really have a significant consequence with regards to asset markets over a durable time horizon, so more than a few weeks, like several quarters or sorry, several months or multiple quarters, and perhaps longer than that, you need to have a adverse outcome in the growth cycle, in the inflation cycle, in the fiscal policy cycle, in the monetary policy cycle, or the liquidity cycle. Right now, we're suggesting that the growth cycle is moving in a positive direction, the inflation cycle is moving in the wrong direction, but because there's structural regime change on the precipice coming out of the Fed, it neutralizes the inflation cycle. Obviously, structural regime change and rate cuts in the Fed is positive in the direction of the monetary policy cycle. The fiscal policy cycle is moving in the wrong direction currently as it relates to the tariff outcome. But again, next year we're talking about $400 to $500 billion of fiscal impulse, $500 to $600 billion of fiscal impulse in 2027. So that will be moving in the positive direction starting early next year. And then what else? And then obviously the net result of that is all generally positive for liquidity, especially in the context of what should be a much lower US dollar on a 1 and 2 year forward time horizon. So, we've been saying like this is one of the best investing environments of all time. And this is why, the markets have been so unrelenting in their refusal to let the bear porn purveyors and their clients in. So in our opinion, we've been saying paradigm C, every dip you see in paradigm C until you hear me say we're going back to paradigm B as in boy, every time you see a dip in paradigm C, if you're not invested enough, get invested. This is an opportunity to do that. So we'll see who takes advantage of the opportunity in 6 months. One thing I wanted to flag with this slide here, this is one of the most lopsided positioning conditions in recorded history on a median basis, not on a mean basis, but on a median basis, which is why we continue to believe our paradigm C bull market ends in a bubble. It's absurd for somebody to get in front of this many institutional investors and say the market might bubble, but it's true. There's too much good stuff happening with too far of a time horizon from this starting point in terms of the positioning cycle to suggest that it's going to do anything but bubble. That seems like the most logical outcome, especially in the context of the AI super cycle potentially creating a jump condition in the trend level of productivity growth in the economy, which will create a jump condition in the trend operating profit of the economy and a jump condition lower in the trend inflation rate of the economy. That's way too much positive stuff happening from this starting point in the positioning cycle for such a durable time horizon to suggest that the market is not going to bubble. Like you have to assume that there's at least a 33% probability of the market bubbling, perhaps even 50%. I'm comfortable saying that is a legitimate risk. Risk works in both directions, not just downside risk. There's upside risk. Every time we refresh the Bayesian inverse process, we get more data and more signal that supports a continuation of paradigm C. And so until that changes, we're going to be fundamentally bullish, irrespective of your man's true social posts. Use our grid model. And by the way, we've been saying this all since the early spring. Has that not been incredibly right? Has that not been the right position to take? I don't think this is any different. I just think he's posturing for art of the deal purposes. We'll see. We use our grid model to assess the probability of regime change in asset markets over medium to long-term time horizon. So we still got growth in terms of grid model. In terms of the grid model, surprising because this is expectations to the upside throughout the duration of our forecast horizon. We have inflation right in line with consensus over the next few months, and then mildly above consensus starting kind of in, I want to say Q1 of next year. Not a significant degree, but mild upside surprise risk, which may slow the process of structural regime change at the Fed. In fact, I fully expect it to slow the process, but by then it'll be so obvious that the economy is doing just fine anyway that I'm not even sure the markets will need more rate cuts at that point. It might be the case that people get freaked out about inflation, but so that might be it may be a good thing from the perspective of not blowing up the bond market, just in terms of unpricing out some rate cuts in the first part of 2026. But by the end of 2026, as a function of whoever takes that job in terms of replacing Jay Powell, we think they will communicate enough credible economic arguments for why the Fed's reaction function needs to structurally and durably evolve from the Powell Fed reaction function to the new Fed chair's reaction function. And in my opinion, we think that process still remains ahead of us and is significantly underappreciated by asset markets, as evidenced by real floor Fed funds rate pricing of positive 13 basis points. We think that number will be minus 50 basis points or somewhere thereabouts on a sustained basis by the end of next year. And until we see that outcome, until we see something that until we see a very clear, clean cut signal from the people that run the Federal Reserve Organization and or the people that run the country that says that's not going to happen, then we have to believe that is going to be the outcome because again, it has to happen. When we come up with these themes about what must happen in a fourth turning as a function of the fiscal dominance regime, which itself is a function of the demand for populism, this stuff has to happen. So let's keep moving here. We use our global liquidity model to now cast the leading indicators of private and public sector liquidity across geographies. As I mentioned, liquidity is trending higher in every economy, major economy in the world, with the exception of Japan. So, and key leading indicators of global liquidity currently signal a significant uptrend over the medium term. So again, if this is true and there is a significant uptrend of global liquidity over the medium term, then this is a buying opportunity, a paradigm C buying opportunity.